and mute myself.
Good afternoon and welcome back. On behalf of USPAACC, I want to welcome each of you to the Business Leadership Series. My name is Tim Fulton. I'm the president of Small Business Matters, and I am your presenter today. Today is the second of a two-segment kind of series on cash flow management. I hope that many of you were with us, would have been 2 weeks ago when we started this series. What we're going to do today is a quick review of what we talked about 2 weeks ago. And then we're going to move into, I'll kind of walk you through a case study of sort and looking at a company's cash flow. And then hopefully when we finish up today, I'll share one of my favorite stories about the importance of cash flow. You may know that here in the United States, there's a high failure rate for small businesses. According to the SBA, the Small Business Administration, roughly 50 to 70% of all small businesses fail within their first 3 to 5 years. And when they've studied these companies that have failed, what they have found that over 80% fail due to poor cash management, not able to best utilize the cash resource that you have. So that's why I think this topic is so important to us. So let's hopefully each of you have a copy of the handout, and if not, we're going to put that hand up on the screen for us, and you can follow through and take notes as we go through it. There we go. So you may recall where we started off 2 weeks ago. The most important financial goals, if you're looking at your company's financial statements, most important goals are profitability and solvency. Profitability, are we generating sufficient return on investment? Solvency, do we have enough cash? And for our purposes today, what we're focusing on is that number two, solvency. Do we have enough cash? You may recall, I think I shared the quote with you that I said, if profit is food to the business, cash flow is oxygen. We have to have cash to operate our business. Let's turn to the next page now. And then I shared with you what I think are the 5 keys to success in financial management for any company, big or small, in this functional area of financial management. The 5 keys, and the 5 keys are: 1, having timely and accurate financial statements; 2, being able to read the financial statements, read and understand financial statements. Number 3 is determining what your key performance indicators are. What numbers do you need to be looking at within your business on a regular basis? And hopefully maybe 1 or 2 of those relate to your company's cash management. Number 4 is managing cash. Very simple. It's the most valuable resource in any business is your cash. So managing cash flow, and again, that's where we're focusing today. And then number 5 is being able to predict the future, being able to look forward and do cash projections and budgets and forecasts and such. So these are the 5 keys to financial management. Then we'll move to the next page. And I walked you through, there are 3 primary financial statements that I want you looking at on a regular basis. And we walked through these in a little bit of detail 2 weeks ago. The first is the income statement. The income statement describes for us the financial performance of a company over a period of time. And it shows revenue, it shows cost of sales, it shows our operating expenses. And then the bottom line, it shows our profit, or in this particular example, a loss in the month of January of just under $5,000. So we start off by looking at the income statement. The second statement we'll turn to next is the company's balance sheet. Equally important, the balance sheet. The balance sheet describes for us 3 things: what a company owns, we call those assets; what a company owes, we call those liabilities; and what is the owner's position in the business, and we call that owner's equity or stockholder equity. So again, you see here example of a balance sheet. My experience is that more companies look at an income statement than a balance sheet, which is unfortunate, because I think the balance sheet, in terms of the quality of the information and the importance of the information, the balance sheet is as, if not more important than the income statement. We tend to be more interested in sales and profit, maybe not as interested in payables and receivables like we see on the balance sheet. But trust me, the balance sheet is as, if not more important in our understanding of our company's financial performance than the income statement. And then the third financial statement, we'll turn to the third one, is the cash flow statement. And for today's discussion, this is the one that we're probably most interested in, the cash flow statement. The cash flow statement describes for us the movement of cash within the business. We can turn to that next page, the cash flow statement. Cash flow statement describes for us the movement of cash within a business over a specific period of time. In this case, we're looking at a 1-month cash flow statement. Cash flow statement answers the old question that I get from clients frequently, and that is, Tim, where's my cash? What happened to my cash? I'm showing maybe a profit on the income statement, but I don't have any cash. I've run out of cash. Where's my cash? And so the cash flow statement describes for us the movement of cash within our business over a period of time. And we start off with beginning cash. In this example, we started the month with $35,000. And then we had some cash outflows from operations. We had, or inflows, we had some cash sales, and we collected some receivables. We had some cash outflows. We had to pay some expenses, and we had to reduce our payables. We paid some cash purchases of inventory. So these would all be uses of cash in terms of operations. So we had cash flow from operations minus $20,850. Remember, this is the same time period that we were looking at both the income statement and the balance sheet. Then we have cash flow from financing and investing. Financing would be cash either coming in or going out from the bank or investors. Cash flow from investing would be either the purchase of fixed assets or the sale of fixed assets. And you can see in this example, we had no cash come in from either financing or investing, but we did have some cash go out. And so we paid the owner's distribution of $2,000. We paid the bank a principal payment of $45.09, and we also paid the bank interest charge of $11.29. Total cash flow from financing and investing minus $76.38. Total cash flow for the month minus $28,488, and we finished the month with ending cash in the bank of $65.12. So as you can tell, if you go back to that income statement and compare it to this cash flow statement, each statement tells a very different story. The income statement is all about profitability. Were we profitable? In this example, we were not. We were about $5,000 in the red. But this cash flow statement tells a different story. It's a story about cash. And in this case, we had a cash deficit of $28,000, same month. Now, why is this important? Well, if all we look at is the income statement, which is not unusual, many companies, if all I look at is the income statement, it's easy to associate profit with cash. And if the income statement showed a loss of $5,000, I could just assume that we had a cash deficit of about $5,000 because we tend to correlate profitability and cash. So I could just assume that, yeah, we probably had a cash deficit of about $5,000. But what we see here on this cash flow statement is that we didn't have a $5,000 cash deficit. In terms of total cash flow, we had a $28,000 cash deficit. And would you not agree there's a big difference between a $5,000 cash deficit and a $28,000 cash deficit? In some cases, that's the difference between staying in business and going out of business. So I want each of you now, as you're looking at your company's financial statements every month, make sure that you're getting a cash flow statement, income statement, balance sheet, cash flow statement. Each one tells a slightly different story. Okay? Now let's turn to the next page now. We're going to switch gears a little bit. I think that's as far as we got 2 weeks ago. So now we're going to look at a different set of financials, kind of a case study of sort. We have a balance sheet on the left, and we have an income statement on the right. The balance sheet is a year-ending balance sheet as of the end of December. The income statement is a 12-month income statement. Income statement on the right, balance sheet on the left. And what we're going to do with these financials is calculate, I'm going to show you about a dozen different financial ratios. And each of these are important. Each of them tell, again, a slightly different story about a company's financial performance. But there are a couple that are particularly significant in terms of cash flow management. And that's where I really want to focus today. So again, we're going to take these financials, and now we're going to turn to the next page, and we're going to look at about a dozen of the most common financial ratios, starting with, and we're going to look at 4 different categories of financial ratios, the first of which are what are called profitability ratios. So let's turn to that next page. So you see profitability ratios. We have gross margin. We can calculate operating margin, net profit margin, just different ways of looking at a company's profitability. Then we can calculate what's called return on assets. Given how much money has been invested in the assets on the balance sheet, how much profit are we generating? You see, in this case, it works out to 3.7%, which tells us that for every dollar that we've invested in our assets, we're getting about a 4-cent return in terms of profitability. Next, you see return on equity. This is one a lot of companies are interested in, and investors are particularly interested in, is within this company, what is the return on equity? Sometimes we call this return on investment, ROI. And we calculate that by taking our net profit from the income statement divided by total shareholder equity on the balance sheet, In this case, it works out to 12.5%, 12.5% return on equity. So, as a company owner, I would be very interested in this because it tells me for the money that I have invested in this company, I'm getting about a 12.5% return. And if I was an investor in the company, I would want to know what this number is. For the money that I have as an outside investor, the money that I've invested in this company, what return am I getting on my investment? And then as a prospective investor, I would be interested in this because I'm thinking about maybe investing my money in this company, and where's that money going to come from? I'm going to have to sell stock. I'm going to have to take it out of my IRA, and I'm going to look to see, okay, what return am I currently getting there versus this return, potential return of 12.5%. So this is a key ratio, both internally and externally. The second category of ratios are called leverage ratios. In business terms, leverage speaks to how much debt we have versus equity. There are only two ways to finance a company, debt and equity. And so this looks at to what degree we're using to finance our company, debt versus equity. The most common leverage ratio is called debt versus equity, where in both these items we would find on the balance sheet how much debt do we have, total liabilities, versus how much equity, shareholder equity, and we divide one by the other. And in this example, we arrive at a ratio of 2.42. And what that's telling us is that for every dollar that's been invested in this business, we've borrowed $2.42. For every dollar that's been invested, we've borrowed $2.42. I can tell you the average for this ratio for all companies, big and small, the average debt to equity ratio is 1. For every dollar of investment, there's a dollar of debt. That's the average across all industries, all size companies. I can also tell you that for most commercial banks today, the maximum debt to equity ratio is 4, meaning if your debt to equity ratio exceeds 4, you are considered unbankable. No one's going to lend you money. So the average is 1. The ceiling, so to speak, on this ratio is 4. So you'd want to keep your debt to equity ratio somewhere between 1 and 4. All right, so that's what's called a leverage ratio, very important. Let's now turn to the next page and we'll look at the next category of ratios. And these are most important for our discussion today, what are called liquidity ratios. Liquidity ratios. Liquidity speaks to how fast can I create cash within my business? How fast can I get my hands on cash within my business? And the most common liquidity ratio is called a company's current ratio. Current ratio. And very simply, to calculate current ratio, we look to the balance sheet and we take our current assets off the balance sheet and divide by our current liabilities. Current assets divided by current liabilities. In this case, it works out to 1.0. Exactly, 1.0. Current ratio of 1.0. Well, what does that mean? Well, I can tell you again, the average current ratio for companies like yours, or all companies, the average current ratio is typically between 1.5 and 2. 1.5 to 2. That's the average. So we see that this company at a current ratio of 1 has less liquidity, less liquid. You may say they're illiquid. Not necessarily a bad thing, but they're less liquid than average. If current ratio exceeded 2, we'd say that, well, that company is highly liquid. If their current ratio is 3 or 4 or maybe even 10, we'd say, well, that company is highly liquid. This is a ratio that banks are going to be very interested in when borrowing money because they want to know that you're fairly liquid. Your suppliers, your vendors, anyone who is dependent upon your company for consistent cash flow, they're going to be looking at your company's current ratio. And then right under that, you see what's called quick ratio. Quick ratio is even a kind of a finer picture of a company's liquidity. And in calculating quick ratio, very similar to current ratio, except we pull out the company's inventory, which is considered the least liquid current asset, least liquid. We pull out inventory and then we calculate the current assets divided by current liabilities. In this example, works out to 0.73. The average for all companies for quick ratio is right about 1. So again, that is an indication that this particular company is less liquid than average. So those are called liquidity ratios, just different ways of looking at our ability to to come up with cash, to create cash within our business. The next category of ratios are called efficiency ratios. And these are ratios that help us look at how we can create more cash, how we can become more efficient in the use of our assets to create a better cash position within our business, how we can become more liquid. The first ratio is called inventory days, and that inventory is, the stuff that you're selling to your customers. If you have inventory, of course, not all companies carry inventory, but if you carry inventory, it measures how efficient you are in flipping your company's inventory. And we calculate what's called inventory days by taking from the balance sheet our average inventory divided by our annual cost of sales, COS, divided by 360, the number of days in the year, kind of. And for this company, we arrive at inventory days of 41.14. So that's telling me that on average, I am turning all of my inventory, I'm selling all of my inventory about every 41 days. Is that a good number? Really depends on the industry. If I'm a grocery store, that would be a terrible number. Grocery stores usually turn their inventory every 10 to 15 days. So this would be a terrible number for a grocery store. If I were a car dealerships turn their inventory maybe once, twice, 3 times a year. This would be an amazing number for a car dealership. So to determine whether it's good or bad, one, you'd look historically, what has it been historically? Two, you'd look at, what did we plan for? What do we want this number to be? And three, you'd look at an industry average to see how your inventory days compares to your industry average. The second efficiency ratio is called days sales outstanding. Sometimes we call this days receivable. How fast are we collecting? How fast are we turning our receivables? Remember, receivables are monies that are owed to us by our customers. And it shows up on our balance sheet, accounts receivable. So we're looking at how fast are we collecting our receivables. And so we take our average accounts receivable right off the balance sheet, divided by our annual revenue, divided by 360. In this case, it works out to 36 days. This company, on average, is collecting their receivables every 36 days. Are you calculating your company's days receivable? Do you know how fast you're collecting your receivables? I think it's really important, particularly in terms of managing cash. Now, how do we determine if this is a good number or not? One, again, we would look historically. How does this compare to 3 months ago, 6 months ago, 12 months ago? How does it compare to our plan, our budget, our projections? And again, how does it compare to maybe an industry average accounts receivable? The fourth way of comparing this, knowing whether it's a good number, is we'd also want to compare it to our credit terms. What have we told our customers that how many days do they have to pay us? What are our credit terms? If our credit terms are 30 days, 36 isn't too bad a number, because what it suggests is we may have several customers that are paying us a little late. Not too bad, but a little late. If this number was 40 days or higher, if it were my company, I would be concerned. If my terms are 30 days, I've told my customers, you have to pay me in 30 days. If this number was 40 or higher, I would certainly be concerned. The next ratio is called days payable outstanding. Days payable are payables, remember, account payables. These are monies that we owe our suppliers, our vendors. Shows up on the balance sheet as well under current liabilities. And here we're measuring how fast are we paying our vendors. So again, we take average accounts payable off the balance sheet divided by annual cost of sales off the income statement divided by 360. In this case, it works out to 51, a little over 51 days, 51.44 days. So that's telling me that on average, I'm paying my vendors, I'm paying my suppliers about every 51 days. Is that a good number? Again, we would say, okay, what has it been historically? What do we plan? How often do we want to pay our vendors? What's the industry average? And then fourth, again, we would look at what are the terms that have been extended to us by our vendors. And if our vendor terms are 30 days, they've said, Tim, you got to pay us in 30 days. Well, I'm not doing very well. I'm taking an extra 21 days, according to this number. More than likely, I'm paying interest charges, late fees. I'm not getting optimal pricing on whatever I'm purchasing. I'm paying a number of penalties for paying so late. So if my terms are 30 days, I would want this number as close to 30 as possible. The next ratio you see there is called total asset turnover. Now, big picture, how efficient are we managing all of our assets? So we take total revenue, 12 months of revenue, divide by total assets, and we arrive at total asset turnover of 1.83. One way to interpret this ratio, it's telling me that for every dollar that I've invested in my assets on the balance sheet, I'm generating revenue of $1.83. Now I want to take you to the final two ratios here. These are two that I find very few companies look at, but boy, particularly in terms of cash management, these are really important. The next one is called cash conversion cycle, CCC, cash conversion cycle. Cash conversion cycle essentially measures how long does it take for a dollar to cycle through my business, knowing that cash goes out, cash comes in, cash goes out, cash comes in. How long does it take to cycle $1? So we calculate this cash conversion cycle by taking three of the previous ratios, days sales outstanding, plus inventory days, minus our days payable outstanding, adding, and subtracting. In this case, the net of those works out to 25.7 days. So this is telling me, on average, it's taking me almost 26 days to turn my cash, to flip my cash. And with this particular ratio, the goal, the objective is to drive this ratio down, lower, as far as possible, because with every day that I can reduce this ratio, I'm freeing up my most valuable resource, which is cash, right? So to get more cash, I need to reduce the number of days in my cash conversion cycle. And you see the three leverage points in creating more cash, three leverage points: inventory, receivables, payables. So if I can manage all three of those as well as possible, I'm going to be creating essentially cash within my business. I'm going to be freeing up cash within my business that I can use to do more marketing or hire better employees, however you want to be able to use your cash. Cash conversion cycle. And then the final ratio there you see is called working capital requirements. And this ratio answers a question that I get frequently from my clients, small business owners just like you. And that question is, Tim, how much cash should I have ready access to? Ready access means cash that I can get my hands on, say, within 24 hours. How much cash do I need to have ready access to make sure that my company never runs out of cash? Because remember, that's our worst case scenario, is when our company runs out of cash. So I never want that to happen. So we need to calculate what's called working capital requirements. And it's very simple. We take the previous ratio, that cash conversion cycle, CCC, and multiply it times our average daily sales, which would be total annual sales divided by 360. And in this case, it works out to $53,523. I tend to look at this ratio as a range So I would say, well, we need to have ready access. That's what this ratio is telling us. We need to have ready access to between $50,000 and $55,000 to make sure that we never run out of cash. And when I say ready access, that would be cash in the bank. That would be if I have a line of credit with the bank, if I have company credit cards, my own personal cash, whatever I have in the bank as the owner of the business, my own personal credit cards, whatever I can access within 24 hours, all those put together. This tells me as the owner of this business, I need to have access to between $50,000 and $55,000. Now, the challenge first of all, I find very few business owners, particularly small, mid-sized companies, very few know this number. And it's important that you know this ratio, this working capital requirements, because you need to know how much cash you need to have access to. Make sure that you don't run out. And one of the biggest challenges for small businesses like yourselves is as you are growing your business, as you're adding more sales, more revenue, what's happening to this ratio? It's going up further and further. It's climbing. As you add more sales, you need to have greater access to cash. There's an old adage that growth consumes cash because as your company grows, you need more employees. You need more office space. You have more receivables. You need more inventory. Growth consumes cash. So you can just expect as you grow more revenue every month, every quarter, every year, this ratio will go up and up and up. And I can guarantee you that if you go to the bank to borrow money, particularly for a line of credit, short-term loan, the bank is going to calculate this ratio. And if you can know this number before you go to the bank, you have a much better chance of being approved for that line of credit. Absolutely. All right. So these are the most common ratios, about a dozen or so most common ratios. And I've got great news for you. After this session, I'm going to be sending, I have a tool that was created for me, an Excel spreadsheet that calculates all of these ratios. All you have to do is plug in your numbers and it'll calculate all these ratios for you. In fact, you can do it over a period of 3 years. So I'll be sending this tool to our friends at USPAACC, and then they'll be sending them to you. So you'll have access to this tool so that you can now calculate your financial ratios. And again, it'll do it over a 3-year period if you have financials for 3 years, so you can compare and contrast these numbers over 3 years. Okay? Now, let's turn to the next page. I have one more tool that I want to share with you to help you better manage your cash and understand cash performance. And it's called marginal cash analysis. And this is a tool that, again, I find very few companies, big and small, very few companies look at this marginal cash analysis. Essentially, marginal cash analysis describes for us what happens to cash when we make a sale. If I go out and make a sale today, what impact is that sale going to have on my cash? We assume that more sales equals more cash, but we have to be very careful because that is not always the case. And that's why we do this calculation to say, okay, what is the impact of a sale on my company's cash? Marginal cash analysis. So I'll walk you through this. And again, I hope after we're done that you will do this own analysis on your numbers. So what we do first is we normalize. We're using the same financials that we've been using to calculate all of the ratios, same numbers, balance sheet, income statement. We're going to normalize these numbers to a $100 sale. So just imagine that I go out today and make a $100 sale. I sell you a $100 widget, so to speak. And then I'm wondering, okay, what is the impact of that $100 sale on cash? So notice where it says on the very top, it says revenue $100. Well, we know previously we saw our cost of goods sold on a $100 sale is $46.70. So our gross margin is $53.80. Okay, so that's where we start. Gross margin, $53.30. We then have to take into consideration the impact of this sale on the balance sheet, receivables, inventory, payables, collectively what we call working capital. And if we just compare the income statement to the balance sheet, just look at the relationship between these numbers, what we would find is that for $100 in revenue, our receivables, we can expect our receivables to go up by $10. Our inventory, we would expect to go up $5, and our payables would go up by $7. And because payables are monies that we owe our vendors, that's considered a negative in this math. So we take the 10 plus the 5 minus the 7, and the net of those is what we call a change in working capital. $100 sale will have a change in working capital of $8. So we take that $8 and subtract it from the gross profit of $53.30, and we arrive at what's called marginal cash flow of $45.30. Marginal cash flow, $100 sale, marginal cash flow of $45.30. The third component of this analysis is then we have to take into consideration our operating expenses, our overhead. And again, if we look back, we'll see that our overhead represents 48%, a little over 48% of our revenue. So if we have a $100 sale, we're going to have operating expenses of $48.70. We subtract that from the marginal cash flow of $45.30, and we arrive at a net, what's called a net variable cash flow of minus $3.40, a negative $3.40. So what is that telling us? That's telling me if I'm the owner of this company, if I go out today and make a $100 sale, the effect of that $100 sale on my cash will be a cash deficit of $3.40. A cash deficit of $3.40. Well, you may be wondering, how could a company operate like this? How could they lose cash on a sale? And the reality is that this is not that unusual, particularly for younger, high growth companies. It's not unusual that you could be profitable on the income statement and yet losing cash with every sale on the cash flow statement. And that's why it's so important to be looking at both profitability and solvency. So again, according to this math, $100 sale, cash deficit, $3.40. So let's turn this maybe something more realistic for some companies. Let's say it's not a $100 sale. Let's say it's $1 million sale. Huge sale for a lot of companies, $1 million sale. So imagine I close a $1 million sale, and I'm wondering, again, as the owner of the company, what impact will that $1 million sale have on our cash? Will it add to cash? Will it take away from cash? Well, using these numbers, assuming nothing changes, what we know is $1 million sale, if you just add zeros, $1 million sale will create a cash deficit of $34,000. Cash deficit of $34,000. So if I know that to be true and I'm about to make $1 million sale, I've got to start asking myself, how will I finance that sale? Where will I come up with $34,000? Am I going to borrow the money? Am I going to look for investment? As the owner of the company, am I going to put $34,000 in the bank? Or the other option is to try to improve this particular analysis. Can I raise prices? Can I get better pricing from my vendors? Either one of those would improve my gross margin. Can I speed up collections? Can I slow down payables? Can I speed up inventory turnover? Any one of those would improve cash flow. And finally, can I reduce my operating expenses? That too would reduce my cash deficit. But if nothing changes, $1 million sale, I would have a cash deficit of $34,000. So again, I encourage you, once you're looking at your financial statements, to do this marginal cash analysis and see what impact, given your company's financial model, what impact are your sales having on cash? And I'll give you just an example of this. I work with a company. I'm in Atlanta, Georgia, and I work with a company. They're a consumer finance company. They've got 6 offices all over Atlanta. We get together as a board once a quarter, and we look at the financials, not only as an aggregate for all 6 offices, but then we look at the financials for each individual office. And one office, the downtown Atlanta office, is the largest office. They have twice as much revenue and twice as much profit as the other 5 offices. It's their best office, the downtown Atlanta office. And as we're looking at their financials, once again, this was a year or so ago, the Atlanta office, highest sales, highest profit. And I turned to the CFO of the company and I said, how much cash are they producing with their sales? And the CFO said, well, look at the profit. That's what they're producing. And I said, well, that's profit. That's not cash. There's a difference. How much cash are they producing? So they did this marginal cash analysis on all 6 offices. It was really interesting. And what they found is that the largest office, the number 1 office, producing the most sales, the most profit, and yet they were number 4 out of 6 offices in producing cash. This was a real eye opener for the owner of the company because he just assumed that Atlanta office was producing the most cash. They weren't. The issue was they were really good at loaning money and they were profitable loans. They weren't very good at collecting their money. They were writing off hundreds of thousands of dollars of loans each year, which was impacting their cash flow. So we want to understand profitability. We want to understand cash flow. Okay. So I hope this information is helpful for you. We're at a good stopping point. So what I'd like to do is I'll stop now and let's see. Do we have any questions for the group? We can take down the handout, and I'll be happy to answer any questions from the group. Pedro, do we have any questions?
Yes. So we have questions from Mercedita. I hope I pronounced your name right. How many months of cash should we have access to cover off on unplanned crisis? It's in the chat.
Yeah. I'm just getting there. Good. Yeah. Yeah. That's a good question. There are 2 ways of looking at that. The one is I normally recommend to my clients that they have 2 to 3 months of overhead expenses in the bank at all times. So if your monthly overhead, your monthly expenses are, say, $50,000, you'd want to have $100,000 to $150,000 in the bank at all times, just to make sure you don't run out of cash. So that's one way to answer that question. How much cash should we have on hand? The second is what we just looked at just now, is that working capital requirements. And again, that's taking into consideration your revenue and your expenses, your cash. And that's just a second way of calculating how much cash you should have access to. So use either one of those, either 2 or 3 times monthly overhead, or calculate your company's working capital requirements. Either one of those will give you a good idea of how much cash you need to have access to. Good question. Is there another question?
We have a question for Thomas.
Okay.
Is there a way to calculate the value of intangible assets, for example, a software that we built, so we can include it as the assets on our balance sheets?
Yeah, most companies, particularly small, mid-sized companies, don't carry intangible assets on their balance sheet. Big companies, you see it all the time. Intangible assets are assets you can't see, you can't touch, but they have value, so they show up on the balance sheet. Not unusual for a technology company to have an intangible asset. Couple ways that you might try to estimate the value of that intangible asset. One is looking at what did it cost to generate that intangible asset in terms of time, money, resources. What did it cost to generate that intangible asset? The second way is to try to come up possibly with a what's referred to as a market value. If I were to sell that intangible assets in the market today, how much could I sell it for? And so that'd be a second way of determining the value. So two different ways, and maybe you would take kind of an average or a median of either one of those and use that as a valuation of your intangible asset. But you do have some leeway in doing that. It's a good question. All right, next question. Do we have another question?
Hello, Tim. It's Thomas calling in.
Yeah.
So how often do you do this financial kind of a KPI review? You do it on a monthly basis, more often, less often?
That's again another very good question. And what I suggest to my clients is that in terms of key performance indicators, that there's some numbers that you want to look at every single day. My rule of thumb for most of my clients is 3 numbers that you should be looking at every single day. And those numbers could be cash in the bank, could be sales the previous day, could be, what are my receivables, but probably as many as 3 numbers you want to look at every day. Every week, I would imagine that there are certain reports that you would be looking at, like a receivables report, a cash flow report, an inventory report. So certain reports you might look at on a weekly basis. And then the financial statements, like the ones that we just looked at, I would want you looking at those on a monthly basis. And when I say monthly is that I tell my clients that they should be looking at the monthly statements by the 10th and no later than the 15th of the following month. So today is the 24th of July. We should already be looking and have looked at June's financial statements. Okay, does that help?
Yes, sir. Thank you.
You're welcome. Another question, a story about a company that turned around cash flow. So one of my favorite stories, and I just read this not too long ago, is about Dell Computers. Dell, you may be familiar with Dell. Michael Dell founded Dell Computers back, I want to say, in the 1980s. Their business model initially was they mass-produced computers, mostly consumer computers. They mass produced them, and then I would call up Dell and I would order a computer, and they'd say, "Yeah, we've got that. We'll send that to you. You'll have it in a couple days. Give us your, we'll send you a bill. Pay us in 30 or 45 days." That was their financial model initially. And using that financial model, they had all sorts of cash flow issues. Michael Dell, the founder, became very frustrated because they were always running low, even nearly running out of cash. So he fired his CFO at the time. He fired his CFO, brought in another CFO, and that new CFO completely changed their financial model, essentially to what it is today. And the way it works at Dell today is if I call up and order a computer today, the first thing they will ask for is my credit card, because if it's a $2,000 computer, they're going to charge my credit card today for $2,000, and they'll get their money from the bank tomorrow or sooner. Then they don't mass produce computers anymore. They produce computers as needed. So when I order a computer, they then call their warehouse and say, "Hey, Tim called. He needs a computer." The warehouse calls the vendors, suppliers, orders the parts. Parts come in, computers assembled in the factory, and then it gets sent out to the consumer, me, in who knows, 7 or 10 days. So think about what happened where before they were waiting for their cash 30, 45 days. and they were spending money on their computers. They'd already invested in their computers. They were able to turn that equation around. They went from, before they made their change, their cash conversion cycle was 66 days. It was taking 66 days to turn $1 of cash at Dell. Within 1 year after they made this change, brought in the new CFO, changed their financial model, after 1 year, their cash conversion cycle went from 66 days to 21 days. Over 40-day reduction in cash conversion. It's hard to reduce cash conversion by 1 day, more or less 40 days. To me, that's like the gold medal in cash conversion. You know, if there were like an Olympics for cash management, Dell won the award. They were able to reduce their cash conversion cycle by over 40 days. Again, focusing on payables, receivables, inventory. So that's another reason to calculate your company's cash conversion cycle and ask yourself, how can we reduce this? How can we lower this? How can we be the Dell of our industry? So that's one of my favorite stories, kind of example of using what we've talked about today. And as a result of that, over a couple years, their stock price, I don't know how this happens, their stock price went up over 17,000%. I've never heard that before. Their earnings per share went way up. Their sales actually went up. Tremendous turnaround in Dell just by that decision in terms of their financial model. Any other questions? Any other questions before we wind up? No? Okay, so I'm going to be sending this tool out to you all that you can use to calculate your financial ratios. If you have any questions, if I can help you, feel free to reach out to me. Tim at smallbusinessmattersonline.com. Feel free to reach out. I also have a newsletter that some of you may already receive. It's a monthly newsletter, and you can find that on our website at smallbusinessmattersonline.com. So thanks for being with us today. I will be back with you on August 7th. I believe it's August 7th. And the topic for that day is going to be building business credit and accessing capital. We're going to talk about how companies like yours can access both debt and equity financing for your business. Look forward to seeing each of you on August 7th. Thank you very much. Bye-bye.
Thank you.
Thank you.